What's up, Squares? Harold Perkins here. It's January of 2024, and the question on everybody's mind is, will this new year bring new optimism and new hope and lower mortgage rates? Maybe. What I am certain of is if you're holding out on buying a house, hoping the rates get back down into the 2s and 3s that we enjoyed in 2020 and 2021, you're gonna have to go to Switzerland. Now, I don't know what the housing or job markets are like in Switzerland, but I'm pretty sure knowing how to make watches would be a really good skill there. Or cheese. But let's assume we're all keeping it American here. And as Americans, what we saw in October of 2023 were mortgage rates at nearly 8%, which is higher than they've been in over 20 years. Couple that with the ever-increasing price of homes, and it was tough to be able to afford a house in 2023. And yes, there are some of us out there that remember double-digit interest rates from the 1980s and 90s. I don't remember that. I'm not that old, but my dad brings it up sometimes when he's yelling at clouds.
Who's laughing now?
But it's not the same as today. 15% interest on an $80,000 house is not as expensive as 8% on a $500,000 house. It's because average income has not increased as much as home prices have. In 1985, the median household income was $58,500 per year. So for the average person in 1985, a house cost about 1.5 times their income. That's affordable. Today, the median household income is $73,450 per year, but the average house costs $431,000, almost 6 times the median household income. Speaking of 1985, I was told there would be hover cars by now. Doc Brown, you lied to me. At the end of December 2023, we saw mortgage rates dip from their peak of 7.83% all the way down to an average of 6.56. What that means to you and me is that the same house now has a mortgage payment that's almost $400 per month less than it was in October. That's great. But why did that happen, and can we expect that downward trend to continue into 2024? The dip in rates happened because Fed Chairman Jerome Powell has indicated that inflation has eased and the Fed expects to cut interest rates into 2024. So the logical assumption is that if the Fed is going to start lowering interest rates this year, then mortgage rates are going to be lower later this year also.
That would be an incorrect assumption.
Commander Data is right. That assumption is flawed. Mortgage rates may not be lower later this year, at least not because of what Jerome Powell said. See, mortgage rates react in anticipation of expected actions. I can show you on a chart. Here's the average locked interest rate the day before the Fed's announcement that they plan to lower interest rates, 7%. Here's the day after, 6.5%. And here's the mortgage industry's reaction the day after. That's a drastic move in rates in just a couple of days at the end of December. What's happened is that all of the anticipated rate reductions by the Fed in 2024 have already been built into mortgage rates today, or more specifically, starting back on December 14th, 2023. Now, for clarification, the Fed does not control mortgage rates. They're talking about the federal funds rate, which is different than mortgage rates.
I mean the same, but different.
But there is a correlation between federal funds and mortgage rates. So what does this mean to you? Well, if you're planning on waiting to purchase a house until later in the year because you think interest rates might be lower, you could end up paying more for that mortgage than you would today. The lower mortgage rates already happened. And that was on December 14th, 2023. If the Fed deviates from their stated plan and does not reduce the federal funds rate as anticipated, we're going to see mortgage rates skyrocket up this year. And that could happen just as fast as we saw rates dip last month. Now, I don't think that will happen. Jerome Powell is a politician, and so he'll try not to backtrack on statements that he's made. And of course, there will be other factors in mortgage rates this year, like inflation, world conflicts, and the presidential election. That's a big deal. And all of those things are unpredictable at this point. So what do we do when things are unpredictable and we want to purchase a home? Only spend what you can afford right now. If you want to buy a house right now and you can afford the payment at current mortgage rates, then do it.
Do it.
Sure, rates might be lower in the future, but if you already own the house, you can refinance it to a lower rate if it makes sense. And if the historical trend of home values increasing stays the same as it always has, then your refinance terms will be more favorable because you'll have more equity in the house. Now, I'm not saying home values only go up. It really depends on how long a timeline you're looking at.
The darkest timeline.
But with the exception of the dark time between 2006 and 2009, the trend is up. If you cannot afford to purchase a home right now, then don't. Don't stretch yourself in the hopes that rates will come down so that you can refinance to a lower payment. It might not happen right away. Or ever. So my prediction for 2024 is that we'll see relatively stable mortgage interest rates until the end of the year when we get the results of the election. Then,
hold on to your butts.
Hold on to your butts. Later, nerds.